I now recognize myself for 5 minutes. Chair Powell, let's talk about the balance sheet. As we've discussed several times before, the consistent and massive growth of the federal debt creates long-run challenges for both the United States and saddles future generations with an onerous burden. But it also creates a challenging environment for the markets as the Treasury market expands in kind. As the Fed engages in quantitative tightening, allowing the Treasuries to roll off, the Fed is careful to ensure that there are ample reserves for the balance sheet. Could you briefly discuss the conditions that determine the ideal level of reserves?
Sure. So let me say that we intend to slow, and we have slowed, but then stop the process of shrinking our balance sheet at a time when we think that reserves are somewhat above the level that we judge to be consistent with our ample reserves framework. So what that means is we want reserves to be ample, meaning we don't want them to suddenly appear to be shortages of reserves. So we're going to think of where those shortages might appear, and we're going to put a buffer on top of that, because nothing good happens when there's not enough liquidity. So that's our overall framework. And right now we feel like all the evidence suggests that reserves are still abundant, which is more than ample.
As you know, in early 2021, the Fed stated that it would invite comments on the supplemental leverage ratio. That has not happened yet. I've made the point that the growth of the U.S. Treasury market paired with a decreased willingness of banks to act as intermediaries is a major issue on the horizon. When former Treasury Secretary Yellen was before this committee last year, I asked her about the resiliency of the Treasury market, specifically about the wisdom of permanently modifying the SLR. She said it's something that the banking regulator should consider. Does the Fed plan to finally look at the SLR?
Yes, I believe we will. I have, for a long time, like others, been somewhat concerned about the levels of liquidity in the Treasury market. The amount of Treasuries has grown much faster than the intermediation capacity has grown, and one obvious thing to do is to reduce the effective supplemental leverage ratio, the bindingness of it. So that's something I do expect we will return to and work on with our new colleagues at the other agencies and get done.
Because I think my colleagues are aware that over the course of recent times, literally we have 8 times as much debt to process, but only half as many major market makers. The Federal Reserve is not immune to politics. You, like every Fed governor, go through a lengthy confirmation process in the Senate. And of course, you're required to answer to Congress in hearings like this. I can trace a major political turning point at the Fed to the passage of Dodd-Frank, which greatly expanded the Fed's regulation and supervision authority. Chairman Powell, do you worry that the independence of the Federal Reserve's monetary policy function is in any way hindered by its role as a bank regulator? Can you do both?
Well, we can and we do, and we'll continue to do that. Clearly, the regulatory and supervisory side is more contentious in political circles, but we will continue to carry it out as best we can and to do so in a non-political way as best we can.
And clearly that'll be a major discussion topic in the task force. In my remaining time, could you discuss the Fed's 5-year review of monetary policy? What are the categories of issues you think that will be helpful to receive feedback on?
So a good part of it will be looking at the changes we made in 2020, which were made in an environment where we had been stuck at the effective lower bound at 0 for 7 years. And the highest we got our rate really was sustainably was 1.5%, and that was the highest of any advanced economy central bank. So the concern was that at the slightest downturn, we'd be back at the 0 lower bound and we'd be stuck. So we were looking for ways to make up for that. So then the question is, we got this inflation out of the pandemic and the events related to it. Are we in a different place now? And I think the chances are pretty good that maybe the effective lower bound is still a concern, but it's not the base case anymore. So we need to look at that and decide how what are the implications of that for our framework.
Thank you, Chairman, and I look forward to several more discussions on these topics. And with that, I yield back the balance of my time, and I recognize the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman.